Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
From 36,000. Ridham, good morning. Thanks a lot for joining us. What's led to this upgrade in Sensex target? What's made you so bullish?
Good morning, Anuj. Good morning, Lata. Good morning, Sonia. Let us, think about this. I think India is on a growth recovery path, which I think began a few months ago. It's likely to translate into better earnings growth, and I think that's the reason why we think stocks are going higher. We've been in a bull market since 2009. It's been a very long bull market, but it's been a very slow one. We've had several corrections along the way. And I think the bull market is now reaching a stage where it is going to get backed by strong fundamentals. Now, obviously, there are a lot of risks along the way, and I think everybody is focused on those risks, which is usually a good time to actually engage in stocks. When people start disregarding risk, that's when I think you get worried. But for now, I think growth is looking good, likely to surprise on the upside. The profit share in GDP is at near all-time lows. So I think we're going to likely witness a very sharp recovery in corporate profit margins over the next 2 or 3 years.
Good morning, Ridham. It's always nice when there's so much negativity around. A veteran like you to say, no, don't look at this, look at 12 months down the line, and it is 42,000. That's definitely exhilarating. But Ridham, since it's a one-year target, I'm not speaking about this next 5 years, 20% CAGR in earnings that your report talks about. A 7% growth country like ours, one would expect this kind of growth in the medium term. But next year, we are riddled with some problems. Interest rates have gone through the roof, as it were. 8.2, who would have thought a year ago? Are companies prepared for that? And even the stronger rupee, the weaker rupee, initially will create disruptions, though later on it might be a big help for both domestic companies and exporters. So, do you think political risk as well as interest rate risk can be very big caveats to your Sensex target?
Now, of course, there are lots of caveats, Lata, and I hate to forecast on points and single-digit or single numbers, which of course makes a lot of good media, but is a very bad way of looking at things. It's certainly not a good framework to think about investing in stocks. The Sensex target is what it is. I don't think we should overly focus on this.
Okay.
But I believe you made some really good points. So let us step back for a moment and think about exactly 12 months ago. If somebody had told you that the rupee will be at 72, 73, that oil will be where it is right now, that the 10-year will be at 8.2, that we will have all this tariff stuff happening around the world, what do you think you would have done with stocks?
You'd have dumped it. Yeah.
And that's the point, right? All this is already in the bag. It's already in the bag. We already know about this. Stock markets are forward-looking animals. They've already baked this in the cake, which is why we're getting such a muted reaction this morning to the additional tariff round, because the market already knew that it was coming. So I think I'll make one more comment, which is that the market is usually right. It goes wrong about a couple of occasions out of, say, 20. And when it's wrong, it's essentially either over-exuberant or it's in panic. So we can recall such things quite easily. Jan 2008 was over-exuberance. March 2009 was panic, or in fact all of the end of 08 and early 09 was panic. We had similar panic in August 13. I think everybody can identify panic and over-exuberance. The market doesn't feel like that right now. It doesn't feel like it's in panic or it's an exuberance. So I would argue that stock prices are more accurately reflecting all these concerns than we can actually fathom. And therefore, I wouldn't really worry about these things. I think the stuff that's going to upset the view on the markets or the performance of stocks is something that we actually don't know that's going to happen in the next few months. All the stuff that we know that's going to happen, I think, is already baked in the cake, if I may use that phrase.
Okay.
So yeah, certainly there are risks. I mean, you know, election results can go all wrong for India. We can get a global recession. We can get a mistake by the Fed. We can get mistake by policymakers in India. So many things can go wrong. And that's true about stock markets at any point in time. But I think we have to weigh those things against what could happen to fundamentals, where the valuations are, and I think on balance it looks like we are in an uptrending market, give or take a few points here and there, and you know, will the Nifty correct over the next few days? Quite possible. But I think over the next year or two, I think it's likely that stocks are higher, not lower.
Ridham, hi, good morning. You spoke about election results briefly, but how do you approach that event? Because if pessimism does rise ahead of or during the election, or you know, with the election outcome, would you still believe that that is a buying opportunity?
Yeah, Sonia, that's going to be a tricky one because it's very hard to tell how things will pan out with respect to elections. What our historical analysis shows is that it's not the nature of the government, but it's actually the leadership at the top that matters to the economy and therefore to the markets. So we've had fragmented coalition governments in the past, and that's had no impact on stock returns because the economy has done okay. And on other occasions, we have had reasonably strong governments, but you know, poor leadership, and that's hurt the market. So it's not something that I can actually forecast with any accuracy, but I think you make a very valid point, which is it's not about what actually happens in May next year, but what the market starts believing will happen. And that is ultimately what's going to drive share prices over the next few months. So if the market starts getting too pessimistic, then I think it's a buying opportunity. If it gets too optimistic, then I think you sit on the sidelines, especially if you're in the business of timing shares, which I think is you know, the privilege of a very few set of people. But you know, if you get those extreme views that the market takes on the election outcome, then I think we can you know, ponder about it and make a call on the market. But right now, there is no signal that the market is ready to make such an extreme call. I believe it may happen over the next 2-3 months, but we'll have to wait and watch.
Yes. Ridham, the issue is 70 to 80% of our audience is in that business, right, of timing it. You know, for longest, the trouble with this market was that it was too narrow. There was a handful, you know, just a set of 7 or 8 stocks, the Bajaj twins, the HDFC twins, which was taking the market higher, and the market breadth was getting very narrow. You know, now we've seen the leadership stocks correct quite a bit. Consumption, for example, has corrected. The NBFC twins have corrected. The retail banks have corrected. Your thoughts on the kind of leadership shift that we have witnessed over the last 3 or 4 months?
So Anuj, I think you've raised a very important point, but I'll make one point. In fact, you've raised 2 points. So let me make 2 points. First, about timing. So again, I'll use another old maxim in the stock market, which is time is more important than timing. And you know, we did this analysis on the Indian stock markets going back 25 years. 100 days of returns account for almost 2/3 of the aggregate index returns. So, you know, there have been about 6,000 trading days in the last 25 years, and 100 days, which is less than 2% of the total time, has accounted for more than 2/3 of the total returns that the index has given. Now, if you are that smart that you could stay in the market for those 100 days and avoid the remaining 5,900 days, obviously you're in the category of a genius, and I suspect that there aren't that many. But for most of us, we'd rather miss these 100 days than catch them. I think that's what will happen. So I think it's important to spend time rather than time it, even for the most, you know, the biggest experts out there. I think it is very hard. Warren Buffett has said that time and again, and I don't mind repeating that advice, that it's better to spend time than time this. I'm using time as a verb and a noun. But anyway, going back to the core issue that you raised about performance breadth, I think that's one of the important things that we are citing in our report that we wrote last week, which is that we believe that performance breadth will widen from here. So the winners of the past few months or past few years, I think, are going to take a bit of a back seat relative to the losers, where we think that fundamentals are inflecting. So for example, take the comparison of the banking financial sector. and take NBFCs versus corporate banks. So very clearly the trade has been in favor of NBFCs against corporate banks, and we think that's going to flip, because we think that the fundamentals for the corporate banks have troughed and there should be a meaningful improvement in earnings. And when I say meaningful improvement, we're not talking about 10-20% growth, we're talking about much more. Magnitude of 40-50% growth in earnings, and therefore 40-50% rise in share prices. Given where the valuations of corporate banks are, I think it's a trade which represents much muted downside risk versus upside risk. So it's a favorable trade for investors. In contrast, NBFCs are going through a period where they will face increasing cost of liabilities. Valuations are not that attractive, so they may underperform. So there are several such reversals in performance that we see over the next 12 to 24 months, largely summarized as follows, which is that the winners of the past few months or past few years may underperform relative to the losers, especially where the fundamentals are turning. So I give you one such example. The other could be consumer discretionary versus consumer staples, where I think the performance may actually move in favor of discretionary stocks versus staples. Now, some of it is already playing out in the market, which is, the leaders have started faltering, and very quietly, the laggards have actually started gaining performance. Now, because the laggards have lost so much share in the indices in terms of weight, they will not tell upon the index performance immediately. Over months, that will build up. But that's, I think, a more important thing that we are conveying in our report compared to the index target, which is the underlying nature of the market, which we think is going to change. It's going to become more like a bull market. In fact, Anuj, it has behaved like a bear market thus far. Bear markets have concentrated performance, where a few handful stocks actually account for everything. I think, if I'm not mistaken, the top 5 Nifty stocks have accounted for 105% of the Nifty performance this year. So everything else is down or flat. So I think that is about to change, and in fact may already be changing. So there may be some portfolio shifts that investors may have to make. I think they have to shed their anchoring towards the winners of the past few years and move towards some of the losers, especially where, as I mentioned earlier, fundamentals are about to inflect.
Okay. I'll just come to the financials and the broadening out in just a bit. But I'm looking at your buy underperformance list. In the buy underperformers list, you have, just for the benefit of our viewers, ACC, Amara Raja, Apollo, Asian Paints, Grasim, ICICI Bank, Indraprastha Gas, ITC, Larsen, MMFSL, Oberoi Realty, Prestige, Shriram Transport, that is, Soba Developers, State Bank, and Ultratech. No drug stock?
Yeah, so these are all in line with what our analysts have as term of recommendations. So it's not just purely on the basis of a quantitative filter of underperformance. So we marry it with our analyst views. So that's why you may find some stocks missing.
Okay. Ridham, just going through your note, you've recently added SBI into your focus list, and you've, in place of names like Infosys, Z and Havels. It's at a very interesting time, right? We've just seen the merger of BOB, Dena and Vijaya. Now, we do know that miracles don't happen with bank mergers, but at a time like this, when there is a fear of other banks being dragged in as aggregators, perhaps PNB, Canara, etc., do you see more money move into some of the stronger names like SBI?
So I think I'll make a general comment rather than any specific stock comment, which is that we think that the corporate banks have seen their worst. We think that the NPL cycle has more or less peaked. The valuations for corporate banks are circa one-time book. I think the PPOP growth, the pre-provisioning profit growth, will be quite strong. It has been recovering, but now I think you will see even strong net profit growth because provisioning will start falling. So the likelihood is that these banks surprise on the upside in terms of earnings, and the stocks are not fully reflecting this. In most cases, the ownership levels have fallen, so investors are not positioned. So that's, I think, the call in favor of corporate banks.
Okay. Ridham, once again, a broad macro point from the market's point of view. All through last year, we saw the market was really running because of domestic liquidity, and all sort of assumptions were made on how much money can flow into the market. The only risk was that some of that new money had not seen correction, and once the correction comes, we would like to see the data. And if you go by the anecdotal data of last 2-3 months, when there was correction volatility, we have seen slowdown in that domestic fund flow. So is there a risk, especially as we move towards election season, that perhaps that part, which was a big support point for the market, might come down a bit?
So Anuj, I'll make 3 points here, because I think this is another very important question that you've asked. So the first point is that we are in a 401k moment. So way back in 1980, the US administration then had opened up 401k accounts to equity investing. Little did people realize what type of flows will come from US households into equities in the subsequent 2 decades. But it was enormous. It surprised everybody on the upside. I think India had such a moment in 2014-15 when the government decided that retirement funds should start investing in equities. I think you will experience geometric progression from the retirement funds, because India's workforce is going to expand. We're going to see millions of people join the workforce. Formalization of the economy is happening. And the current percentage that they are putting into equity funds will only grow. So right now the number is 15. I expect the number to eventually settle at 40. And this is a very, I think, a very smart decision by the government, because otherwise retirement funds will not be able to service the expected returns only from bonds. So it's a decision that was made at a very appropriate time. And therefore what you should look at, I know everybody looks at domestic flows in mutual funds because that's the data that comes on a monthly basis, but look at what the retirement funds are doing. That number is now likely to be at about $500 million a month. It's about $4 billion a year, and it will rise to $6 billion next year, and will rise another 50-60% the year after that, and another 50-60% after that. Very soon, the flows from retirement funds will dwarf every other flow in the market. So keep an eye on that. Obviously, in domestic mutual funds may also continue to receive flows, which is our fundamental view, that there has been a shift in the way the economy is being managed. The RBI has a new mandate, which is very inflation oriented. If inflation is kept under control, as they have successfully done over the last 2 or 3 years, and mind you, rising oil has still not fed into inflation because real rates are positive. So the second round impact of rising oil and depreciating INR is unlikely to feed into inflation, and if the RBI ever senses that it's happening, they will hike interest rates. This is a good environment for financial assets. You're getting rewarded for saving, and equities represent one of the better financial instruments. So the policy-induced flow into equities, I think, will continue. Will we get month-on-month volatility like we've seen more recently? Of course we will. But Anuj, again, here, step back for a moment, and if I had told you 6 months ago that the small cap index was going to fall 20%, and I've asked this question to many people, most people thought that flows in India will turn negative. They haven't. We're still dealing with positive flows. No doubt they are SIP flows, and the discretionary flows or lump sum flows have probably gone down to zero. But the fact is that most people would have said that flows will turn negative. So I think the flows are exhibiting great amount of resilience. So that's the first point. The second point is that I think this obsession about flows driving share prices should be done away with. It's share prices that drive flows, not flows driving share prices. I mean, I have repeated this point, and it's such a naive point actually, but every buyer in the market has a seller. Flow does not have a net impact. What has the impact is the force of the bid, which is how desperate is the flow to buy shares. And right now, clearly the force of the bid has gone away. There is an offer in the market, and therefore share prices are going down. At the end of the day, the net flow is always zero. So I think flows don't drive share prices drive them. So far as share prices are okay, flows will come back, including FII flows. In fact, I would actually say that it's quite likely that even foreign investors who've been selling for the past several months, come back to the market. So I think those are the points which I'll make to your question, which I think is an important one.
Okay. Well, actually, you took away my next question partly. We have seen this 13% depreciation of the currency year to date, and maybe a large part of it has come in the last 7-8 weeks. Now, is it attractive enough? Both the fact that the Nifty itself has fallen, from 11,800 to 11,350, as well as the currency has fallen. So are we on the cusp of the return of foreign investors?
See, I think, Lata, foreign investors weigh the opportunity against several other country opportunities that they have, unlike domestic investors who are only investing in one market. Now, the fact is that emerging markets around the world have got really smacked. I mean, India has been an outperformer, right?
Yep.
So there's a lot of value that has emerged emerged in emerging markets over the past few months because of the price damage that has taken place, and the currencies in emerging markets everywhere are down. India is not isolated in this regard. This is very different from 2013, where a handful of countries, including India, were hurt. So that all depends on the relative opportunity. If you look at my emerging market strategist, Jonathan Garner, his view is still that we are in a bear market in the EM world. And so far as we are in this EM bear market, I think India will be okay, because India's fundamentals on a relative basis are far superior. Mind you, India is no longer cheap relative to emerging markets. If you look at the relative price to book or relative price to earnings multiples, these are now approaching peak levels. So if there's a bounce back in EM, India will underperform. Now, that may not matter to people at home, because if EM bounces back, then absolute Nifty levels will also rise, albeit slower than what other markets around the world experience. So that's about FPI flows. So if there is further turmoil in the world, I think India will be okay. But if the turmoil becomes really bad and there's capitulation in markets, then you know how quality stocks fare when there's capitulation. They get smacked as well. So I think that's certainly a risk for India over the next 2-3 months.
The best performing sector this year, Ridham, has been the IT space, but your house has now become a bit cautious on that space. In fact, you recently downgraded Infosys as well. Is it only because of the run-up that these stocks have seen that you guys are cautious, or do you think structurally something is changing?
So Sonia, we downgraded technology to underweight on Friday evening. I think that the sector's relative earnings growth will look inferior to the rest of the market, because we expect domestic earnings to do a whole lot better over the next 12 months. Of course, performance has also been very strong, and valuations have also nudged higher. They're nowhere close to the peak relative valuations that technology used to have, say, 10-12 years ago. But there's no reason to believe that it goes back there, because the earnings profile for these companies is now very different. But the key call is about relative earnings growth, which I think is going to be against the tech sector. And a lot of the rupee has also depreciated. So, bulk of the rupee trade is also in the price. So these are the couple of reasons why we've actually gone underweight tech. The sectors that we like are financials, mostly corporate banks, select retail and NBFCs. We like industrials, and we like discretionary consumption. And in fact, I'm underweight everything else.
No, you've got 3 real estate companies in your buy underperformance list. You have Oberoi, Prestige, Soba.
Financials. That's financials.
Okay. You count
That's
real
financials.
estate as financials.
So real estate is a subsector in financials. Yeah. Real estate is a subsector in financials. I would think that real estate is a very good place to be. I think the real estate companies should experience much better volume growth over the next few years, and stocks are pretty attractively valued. So it's one of the sectors where I'm actually quite bullish, especially in the organized sector, because with a bit of lag, RERA will, I think, create a moat for these businesses which operate in the organized sector, and will actually lead to better growth. The consumer is far better protected now, and I think the consumer wants to come back to buy, not for investing, but for actually staying in the houses. So I think that demand is coming back across the length and breadth of the country. And it's very consistent with our view that GDP growth is accelerating. Real estate is a very important component of overall growth.
Okay. Ridham Desai, 25 minutes have zipped past. It was a pleasure speaking with you. Thank you very much for dropping by and giving us the benefit of your views. Sensex at 42,000, that will still be our headline. Thank you very much for joining us.